Here are three ways that moving in a year affects taxes. Number one, there's an exemption for your primary residence from capital gain taxes. The exemption is $250,000 per person, so $500,000 for a married couple. If you lived there 2 out of the last 5 years, if you didn't use it for business, if you didn't buy it through a 1031 exchange, then you might qualify for that exemption amount after you sell your house. What is capital gain? It's when you take the sales price minus what you paid for it and any capital improvements, that's the amount of your gain. So 250,000 for a lot of people protects a lot of any potential gain. And if a married couple, 500,000 usually does a lot of that difference. Number two, you can usually deduct moving expenses. So if you're moving, make sure you capture them so that you can show them to your accountant and see whether or not you can deduct them. And number three, let's think one more time about property taxes. A lot of that gets taken care of at the closing table on your settlement statement. But if you paid cash or you're not withholding, if you're not in escrow, make sure that you've gotten the new property tax bill for your new home so that you're paying it. If it was paid at your closing, if it's being paid by your bank, you might be okay. But if you didn't escrow or you paid cash, you want to make sure you're making those local property tax payments. Otherwise, there could be liens put on your property. For this and more tips, give us a like, give us a follow, and share it anywhere you think someone would find this useful.